Okay, today I'm gonna be presenting a case study on D&O Green Technologies Bhd. This is a company listed on Bursa, Malaysia, and it has caught my attention lately because some brokers and some people have been writing about them and seems like they are quite a hot stock. And I look at their share price lately, it has sort of dropped from the top and kind of stagnated. I usually like it to pick up some things that has stagnated before they start picking up again. So that's why I think it is a good opportunity for me to dive deeper and check whether this stocks has any real merits to it or is it just hype. Okay, but before I move on, I'm not trying to say this is even a hot stock. In fact, this has already been sort of forgotten. That's why I say it's a bit stagnant now. So what does D&O Green Technology do? Right? Let's do a case study on it. And again, the same thing. As I'm going through this case study, my idea is to have you be able to understand how I look at companies and how I do case study as well. So this screenshot was gotten from the annual report, and it tells me that D&O is a company that mainly do its business through this subsidiary called Dominant Opto Technologies Bhd. So this D&O group owns this Dominant Opto Technologies Bhd, which is a world leading, everybody like to say they're world leading, but what do they do? Surface mount LED manufacturer. So they are a surface mount LED manufacturer. So they make LED, right? LED light. But what are surface mount? Later we will look at them, right? And they want to be trusted and reliable partner, and their business is being done globally via China, USA, Japan, Europe, Korea, and India. All right? And this has been their revenue trend in the past. In the past, since 2014, they have been doing business that is quite mixed. Half of their business is LED for automotive, half of their business is whatever LED. But since they have started to focus more and more on manufacturing for LED businesses for automotive, that means car, specializing in car, right? So after that, what happened is you can see the trend as they, even though their revenue did not increase that much, but as they scale up their automotive revenue, the profit increases as well. So this is something very interesting, right? And what are surface mount LED? Surface mount LED are something like this, right? LED lights that are enclosed in a certain kind of plastic or some material that can be any shape, right? So without further ado, let me show you a video that will identify to you what are the products that D&O does. So let me, time to cue the video, right? Cueing the video, and this is the video.
The philosophy of the company is that high-quality products already produced be kept under the most Primax Power Dominant.
This is their
Power in
product.
terms of brightness, viewing angle, and application possibilities. We have standard power dominant and one LED power dominant. Primax. Primax delivers high-intensity illumination. A small package outline and high intensity make it an ideal choice for backlighting, signage, exterior automotive lighting, and decorative lighting. SP Nova. Its staggering brilliance and significant flux output places SP Nova as the Spice LED. This package is a proof for the exemplary integration of the copper LED frame and an encapsulation with high temperature resistant of vehicles' headlights, automotive interior and exterior lighting, central consoles, odometers, automotive signal lights, traffic lights, channel lights.
So I think you get the idea now of what kind of business does D&O do? They are doing LED businesses. Okay, so being in the LED sector and in the automotive sector, let's look at the industry trend. What happens is recently battery powered electric vehicle, or short name for BEV, right, is increasing. That means there are more and more electric car. In fact, the number of electric car being used on the road has increased 74% in 2018. So that's a very incredible growth, right? And it's estimated by this LED Insight, it's estimated that automotive LED, this industry, the revenue and the size is estimated to grow 15% year on year in 2018, and it should continue to increase that way. Why? Because as there are more electric car and there are more LED being put into the electric car design, you see the new car, a lot of them are no longer offering the halogen one, right? A lot of them are offering LED even for the non-premium choice, right? And nowadays a lot of the cars are using LED for ambient light and styling, and that's why there are more and more demand for this in cars. And hence, their revenue has been increasing steadily over the years, right? Nothing very impressive here because it's like a 5-10% increase per year only. But what's interesting is the profit, right? As you can see, once they switch to automotive, focusing on much more on automotive and specializing there, their profit margin increase. So where do they do most of their business? Actually, they do most of their business in Asia, specifically China, right? You can say over 60% of their revenue come from China, and followed by Europe, followed by United States. So China's economy is very important when you are talking about D&O. It will really be affected, right? D&O also recorded a revenue growth of 5.9% or 27.4 million increase, right? But they are supposed to have more because this increase was weakened due to the strengthening of Malaysia ringgit against US dollar against renminbi, right? Otherwise, taking out this Malaysia ringgit strengthening effect, because they make money in US, if Malaysia ringgit strengthen, US dollar weaken, when convert back, they get less ringgit. So if taking away this effect, their revenue would have increased 11%. Nonetheless, the gross profit has increased 20% to 140 million, right? Fueled by higher revenue and margin expansion. Why? Let me put it very simple to you. They actually did something called Forex Hedging. That means because they make money in US dollar renminbi, as US dollar renminbi weaken against ringgit Malaysia, they actually make money from this Forex Hedging. That's why their profit margin is increased compared to the revenue growth, right? They get less revenue, but they make money from the Forex Hedging contract. That's why profit also increased a lot. But this was dampened by the use of this profit into R&D expenses of 29.3 million. Okay, and this R&D is a compulsory because there's a new regulation, especially in Europe, for cars to be tested to be AEC Q102 compliant, right? So the LED has to be this specification compliant. Now, how's the prospect of the industry of this business? I like it when companies write this. Expect its earnings growth trend to continue. So they expect themselves to continue to increase their earning despite a momentary slowdown in vehicle demand, right? Due to consumer. Actually, last year there was a quarter where a lot of the car sales dropped a lot. That's why this company share price followed to drop, because a lot of people are afraid. China car sales has weakened a lot. But what happened was China's government has decided to boost consumers' consumption by cutting the tax, right? By giving a tax cut. And they expect this to be a positive boost to 2019, right? And the long-term growth prospect of automotive LED demand remain intact. This is what they think, right? Driven by rising LED usage per car through introduction of LED application, etc. So this is what we already talked. But they also expect their capex over the next few years to remain high as they continue to build up additional capacity and improve efficiency. So we know that this is a company that is growing and they have found sort of like the right market for them and they are betting on it, which is automotive market, and this market should be growing into the future. I don't see why not as well. So that's why they're going to focus on investing more into plant, property, equipment to facilitate this kind of growth. Okay. All right. So let's look at the management team. This is the chairman, Datuk Muhammad Aslan Hashim. He is not a nobody because if you read at him, he is also chairman of IHH Healthcare, right? And he used to be chief executive of Bumiputra Merchant Banks, right? BMBB, right? And also used to be the group managing director of Emana Capital Malaysia Bhd and executive chairman of Bursa Malaysia. Wow, right? So this is somebody. And the CEO, group managing director of D&O, actually climbed his way up from an electric engineer, and he worked in a lot of semiconductor company, and then after that he focused on opto, which is light, LED and light, right? And then after that he is a chartered engineer, etc., and he has worked a long time, and now he's in this D&O. He has climbed to the top position. And Low Tech Bank is the COO of this company. He as well came from a mechatronic degree background from UK, and he worked his way up in the company. Worked his way up from in a multinational company to a product development manager before he left the company in 2000. Mr. Low is currently the COO of Dominant. So all these are experienced people, as well as executive chairman Chiam Dao Peng, right? 66 years old, appointed as executive director of D&O. Started his career as a production supervisor, etc. So you can see these are all very experienced, especially in the semiconductor field. So let's look at, so we already know management is very experienced in this. It's not like their father asked them to join, no, right? But from the profile, it seems that none of them started this business, right? It seems like they're all workers. They work their way up in this D&O. Anyway, so let's look at their salary. Is it fair? And when I look at this salary, right, it's a yearly salary. There's a typo there. It cannot be 52 million or 600 million per year. This is the net amount, right? Without the adding another 30. Actually quite unprofessional for the people that do the annual report to have this kind of mistake. Anyway, if you look at their remuneration, it's actually quite fair. The top guy, the CEO, only gets 600,000 a year. So per month only 50,000, which is not high, you know, especially for a company that is having 500 million in revenue, right? It's not very high. And the rest of them actually get quite okay. It's okay kind of revenue, kind of salary, not too great, right? Some 20,000 a month, some 30,000 a month. COO get 30,000 a month, right? But what you see here is they have been accumulating share via ESOS, Employee Share Option Scheme. And at the same time, they have been disposing it a lot, right? Last year, end of last year, right? Actually, the whole of last year, they have been disposing the share of this company by a lot. Especially the chairman, right, has been disposing in tens of million, right, ringgit kind of magnitude. Especially end of last year when it was 90 cents. But now that the share price is 60 cents, they have stopped disposing. So let's look at their cash flow, right? We see that revenue has been okay and the profit has been growing. For them to grow further, they need to grow their capacity as well. as grow their revenue, but they expect the earning to continue to grow. So let's see the net income, yes, has been growing as well. We already know that. But the operating cash flow, when compared to the net profit, has been quite healthy actually, right? Operating cash flow has been quite healthy because they have actually been accumulating more and more payable, right? More and more payable. And then a lot of the cash flow they actually get, but they deduct it from the profit in the form of depreciation. And this is actually a proper deduction for appreciation, because look how much money they are spending on capex. They are spending a lot of money buying fixed asset in order to grow their business, right? So this is the nature of the business. It's very competitive because it's not like you have a brand or what. You always compete on producing the best product at the cheapest price. So you always have to spend money on R&D, always have to outdo competition, always have to throw money. That's the bad thing about this kind of business. Manufacturing business as a whole are not that great. Okay, cash, let's look at their cash. Their cash now is 38 million. Okay, a lot of money. I would love to have that money. But their receivable is 92 million. That's too much, right? But then this is what happens in the manufacturing business. Inventory, the LED lights, work in progress, those finished product, etc. is 145 million. They have purposely increased this. That's what they say in the annual report, because they want to be able to supply to their customer faster. Because now they have ready stock, they can supply to their customer faster. And the current asset total is 284 million. The property, plant, equipment is 200 million, has been increasing as well since last year. Actually, they are building a new building as well, moving in this year. Short-term debt, how do I know all of these are from the annual report? Okay, and the news. Short-term debt and current portion of long-term debt is 47 million. So actually, short-term wise, their cash is a bit tight, you know, because they have to pay 47 million in a year, but now cash at hand, they have only 30-something million, so a bit tight. Payable, 88 million, but this payable, they can drag one, usually. Total current liability, 152 million. Long-term debt, not much. They don't have that much long-term debt, right? So total equity, they have 360 million. Total liability, 180 million. So about 50% debt to equity, right? Okay, that's okay. And then let's look at their profit margin. Their profit margin has been increasing over the year, as well as the ROE has been increasing. So this is a very good sign. They are actually, and usually business ROE don't change much. But in this case, it's legit why they will change so much, because they have changed the nature of their business to focus more on automotive, right? So that's why higher net profit margin, higher ROE. So what's a valuation? How do we value this company? We can value it using PEG. So let's look at growth. Where do we pick the growth? It's already in the annual report. It says it's estimated to grow 15% year on year, the LED, automotive LED. And this company, now almost 100% of their revenue are coming from LED, automotive. As long as the profit margin is the same, they are supposed to grow their earning at 15% per annum as well, or more. 15% per annum is assuming they only maintain their market share. If they eat into other people's market share, it will be more, right? If their market share get eaten, then it will be less. But of course, this company so far has demonstrated that they are capable of maintaining or expanding their market share. So let's assume 15% growth, and let's take the earning per share, which is 3.34 cents. So using PEG, PEG says the right PE of a company is equals to the growth rate. So if the growth rate is 15, the right PE is supposed to be 15. So PE equals to price over earning. The right price should be 15 times the earning per share, which is 3.3. The result that we get is this company, the intrinsic value should be 49.5 cents. But the share price now is actually 60 to 61 cents. So it's not considered cheap. But you want to get it cheap, also difficult. It's slightly overvalued, right? But it's a growth company. If you are confident this is a strong company, can continue, it's not a super bad purchase if you buy it now, right? But if you look at the technical chart, as of the time of making this company is at a support now. Okay, so 60 cents is an okay price to buy. But let's look at the BB. They are actually at the BB mid now, and the MACD is weakening because it's closing, right? Closing, looking like it's going to go downtrend, and the RSI is quite high. So I wouldn't think it's a good time to buy, especially not buy a lot. And last check, the share price was 615. It could retrace, testing 0.6 again. If you want to scale in at 0.6, as in buy a little bit first, you can consider, right? But it's not a great purchase. But if you insist to do trading, then you can, right? And one thing you have to be careful, especially investing in a manufacturing company, in a cyclical, especially automotive industry. If the automotive industry drop in sales, this company will follow, especially when there's trade war now or economic uncertainty, this company will suffer. Because when you don't have so much money around, how can you buy that many new car, right? So only when you produce new car, they get more money. Let's look at their recent quarterly report. I like to see it because all the quarterly report lately that they have always report higher earning year on over year. So this is very, very good news to see. Very, very good to see. And all of these are higher than 15%. So our estimation is quite conservative already. And then remember, a weak US dollar will lead to higher profit for this company because they did Forex hedging. And recently, Federal Reserve has announced they want to do tax cut. So when they do tax cut, that could mean that this company, rate cut, interest rate cut. When they cut their interest rate, US dollar will weaken. This company could make more money. Why? Because in the annual report, they have stated effect of profit after tax by US dollar weakening by 5% is this company will make an additional 1 million. Cool, right? Yeah. And if there's a trade truce, now it's trade war, but let's say Xi Jinping and Donald Trump shake hands, no more trade war uncertainty. Wow, that will really bring this company share price to shoot up. Okay. And another thing that you can have to watch out for is this company actually recently they acquired the balance portion of one of their subsidiary, and they issue this ICPS share to acquire the subsidiary. And the conversion price is at 61 cents. So this person just have to pay 61 cents to, they issue this share at a sort of face value of 61 cents. That means if I'm buying your company with 6.1 million, I will give 10 million share, ICPS share for you. And this 10 million share can be converted to D&O share anytime. So the cost is about 61 cents. So they wouldn't want to sell it below 61 cents. Okay? That's what I think, right? Those people that are holding this ICPS share wouldn't want, because people's psychology is, I don't want to lose money. But at 61 cents, they will sell, right? Because in their head, it's already the fixed price. So after this 450 million shares is being sold, maybe the company will start to climb again, right? Their share price. For me, D&O is not a great investment stock because there are so many other super good investment stock out there. It's just good but not great. If you want to do trading on it, you can consider to scale in at 60 cents if you insist to trade, and you wait for the price to be BB low, RSI low, MACD start to trending up, and the price is around 60 cents. That I would think will be an okay entry price. And once you've bought that, and you need to know when to sell, then you have to have your rule. Are you gonna go for short, small profit or bigger profit? Then when you want to exit, you just look for resistance by using FIBO to help you to guide resistance or the pass. Or you look at the RSI is at the high range or the BB at the high range, and the MACD has started to weaken. That's all on my presentation on D&O. Hope you have enjoyed it. Any question? Comment below.